The 9 core business valuation methods used by investors. How businesses are really valued. Why multiple methods matter. No valuation method is perfect. Each has strengths and limitations depending on the company's stage, revenue profile, industry, and the purpose of the valuation. Using multiple methods provides a range of values to validate conclusions, different perspectives on what drives value, credibility with sophisticated investors and lenders, a stronger negotiating position, protection against relying on a single flawed assumption. Professional valuations triangulate results. That is what creates defensible conclusions. The core valuation methodologies. Let's walk through the most widely used valuation methods. 1. Discounted cash flow, DCF. The DCF projects future cash flows, typically over 3 to 5 years, and discounts them back to today's value using a risk-adjusted discount rate. The result is the net present value of the business. DCF answers a simple question: what are future earnings worth today? This method works best for mature businesses with predictable revenue and stable margins. Key inputs include revenue projections, profit margins, discount rate, often based on weighted average cost of capital, and terminal value assumptions. DCF is rigorous, but it depends heavily on realistic forecasting. 2. Market multiples. Market-based valuation compares your company to similar businesses. Common multiples include revenue multiples and EBITDA multiples. If comparable companies are trading at 8 times revenue, that becomes a benchmark. However, multiples must be adjusted for growth rate, risk, and sector norms. A fast-growing SaaS company will attract a different multiple than a traditional service firm. Market multiples are widely used in M&A and fundraising discussions. 3. Asset-based valuation. This method focuses on net assets, total assets minus total liabilities, valued at fair market value. It is most relevant for asset-heavy businesses, holding companies, or distressed situations where earnings-based methods may understate underlying asset value. This approach values what the company owns rather than what it earns. 4. Venture capital method. The VC method works backwards from a projected exit valuation. It determines today's pre-money valuation based on expected exit value, time to exit, target investor return, often expressed as IRR, expected dilution. This is widely used in venture capital and growth stage fundraising. 5. Berkus method. The Berkus method is used for very early stage startups. It assigns monetary value to 5 key milestones: the idea, the prototype, the management team, strategic relationships, early product rollout or sales. Each milestone contributes incremental value within a ceiling. This method is useful when financial projections are highly speculative. 6. Scorecard method. The scorecard method compares a startup to similar funded companies. It adjusts a regional median pre-money valuation based on weighted factors such as team strength, market size, product stage, competitive position, sales capability. This method is common at seed stage. 7. Risk factor summation. This approach starts from a base valuation and adjusts it based on structured risk categories. These include management risk, market risk, technology risk, regulatory risk, and execution risk. Each risk factor adjusts the valuation up or down. This method supports early-stage valuations where structured risk assessment is essential. 8. First Chicago method. This method models 3 scenarios: best case, base case, worst case. Each scenario includes revenue projections, margins, and exit assumptions. The scenarios are probability-weighted to produce a blended valuation. This approach is useful for businesses with high uncertainty or multiple plausible outcomes. 9. Precedent transactions. This method benchmarks valuation against actual acquisition prices paid for comparable businesses. Deal multiples from completed transactions provide real market reference points. This is especially relevant in M&A and exit planning. How professional reports use these methods. Each method produces its own result. For example, DCF might suggest £4 million, market multiples might suggest £5 million, the VC method might suggest £4.5 million. None of these figures are automatically wrong. They reflect different frameworks and assumptions. Professional valuation reports weight the methods based on relevance and reliability. The final outcome is a weighted range: low, mid, and high, not a single fixed number. That range becomes your negotiation framework. Common mistakes applying DCF to a pre-revenue startup. Using revenue multiples without adjusting for growth. Ignoring sector benchmarks. relying on only one method. Sophisticated investors expect structured triangulation, not a single unsupported figure. There is no universally most accurate valuation method. Accuracy depends on the company's stage, the quality of data, and the purpose of the valuation. The strongest valuations combine multiple methods and clearly explain assumptions. If you would like to see which methods apply to your business, you can try the free business valuation calculator at www.valuation4u.com. And if this was helpful, subscribe for more clear guidance on business valuation, fundraising, and strategic finance. For more information, visit our www.valuation4u.com. Remember to subscribe and like our videos.